All right, we'll fire up the delivery message here at o'clock Eastern Standard Time here on the live stream and YouTube. Welcome to the folks who've been kind of waiting and having some discussion with me before the stream tonight. Obviously, it is my birthday, and you can see by the look on my face, I'm just ecstatic about getting 1 year older. I think I'm going to wrap in a message about investing in tonight's live stream. I'm going to show you what I got tonight in the mail, actually, from my mother and father on the West Coast. I'm actually extremely excited about that. So I got a little piece of the Northwest. I'm going to share that with you guys. But I'm going to kind of wrap tonight's message into a little bit of a reflective opportunity. And the reason why this message is a little bit different in that I don't really come on. I do share the way I invest, and I expect that everybody gets a little bit of entertainment in knowing how I realistically deploy some of the techniques that I talk about. But the reason why this topic is so infinite is because everybody's situation is completely different. Everybody's goals are completely different. I was just having a great discussion with Christopher Blaine here in community discussion. I'd really, if everybody wants to review that, that's kind of going to tie into the lesson that I've got tonight about asking yourself the what ifs about investing. And there's never a better time. I'm usually a pretty reflective guy. I typically do a lot of reflecting on why I do what I've done in my life and the mistakes that I've made and what would I have done different had I had the opportunity to maybe do it again. Quite honestly, this opportunity through YouTube allows especially young folks and older folks alike to come on and share in that mentality. And I contend that it's really never too late to take a different approach. I offer one avenue, lots of different aspects of life, but we touch on the financial aspect on this channel. What could you have done differently? What would you do differently? If I was 20 years old and I just put $50 a month, starting with zero starting capital, I would have been guaranteed to have six figures, $128,000 to be exact. I would have contributed only $25,000 to that account over a 40-year time cycle. I think anybody who's new to the channel or popping into the live stream tonight, listening to a fellow like me reflect on what it is that I've done. Mistakes, yes, certainly, but also have had the fortitude, certainly, to power through a couple of very severe downturns in the stock market and multiple corrections, guys, way too many to talk about. And it's nice to be able to hear from somebody like myself how it is that maybe some of the things that I've done right, maybe some of the things that I could have done differently. And that very example that I pose to you guys, and for the new folks that maybe make their way in and go, what did he just say? $50 a month with zero starting capital is going to render me $125,000. Now, if I had it to do over again, honestly, I would have just put a barometer in the stock market and started my Roth IRA and invested solely in the S&P 500. Honestly, when you're 20 years old, you really don't need to be discussing an allocation of bonds at that point. You can take the risk. You can, whether or not you think you can or not. I think, unfortunately, the double end of the sword is that a lot of younger folks think that they can just beat the market when that may be true. It's probably not true, but it's also not necessary at that point, really, just to put a plan on autopilot and set it up for the long term and to guarantee yourself almost that buffer. Now, that's assuming an annual rate of return of 7%, which is fairly conservative, with a fee structure of 0.03, which is right in line with the S&P 500's ETF VOO from Vanguard. Those products we talk about all the time. So again, I do just want to stress that I share what it is that I do in my multiple investing accounts and my taxable brokerage accounts with you guys. But just because I share that doesn't mean that it's something that a new investor has to look at and say, I want that and I want it tomorrow. I think you're really getting, if you're extracting the correct amount of benefit from this message, it's if you come on and you start answering some of the questions for yourself, like, you know, how much should I be investing? How much am I going to need when I retire? And there's no better time than on a birthday to start kind of reflecting on that. And I ran my numbers through, and I'm still on track for my 7 figures. Multiple, you know, I could probably be pushing around 300,000 if I ended up keeping the accounts, 3 million. If I kept the accounts in there until I was 82. I would rather enjoy my money before that, but I'm a little bit more realistic with my program. My current track puts me on a little bit more than $1 million when I do end up retiring. That's just how my numbers shake out. What does that mean for you? Well, if you've never run yourself through the scenario-based investing, I highly encourage you guys to ask some of these questions. And it'll really start you along a line of thinking of asking, what do I need to do? Where am I right now? And this is scary stuff for a lot of people. A lot of people don't like to answer that because they don't like the answers that come forward. And I think it's very easy to get caught up in I can always be doing better. You know, so therefore I don't want to look. I'd rather keep my head in the sand. I'd rather be conveniently naive with my program and just continue to live my day-to-day life and not have to subject myself to that level of scrutiny. I think that can be a big mistake. And if you can look at that type of rhetorical thinking, that type of questioning, you know, what is it that did I get started too late? I started within the last couple of years. What are my numbers if I run them through? And of course, the investment calculator that I offer for you guys, there's a lot of constants there. Now, a compounding calculator is not going to be the end all be all, okay? And I like to consider this the unrealistic versus the realistic approach. You can run your numbers through a mathematical compounding calculator all day. The one that I recommend all the time is off of the Trading Academy. It's the very best one because it's the only one that I've found that gives you accurate assessment and allows you to compare 3 scenarios in one particular scenario. And that allows you to put different fee values in there and compare the expense. I just ran the exercise for Christopher Blaine when I offered my answer back to him. The difference for him in 18 years is going to be $30,000 between the fund that he's in there and between a low-cost ETF. Now, that's assuming that the rate of returns are the same. Now, the rates of return in those 2 funds, correct me if I'm wrong, I liked the one that I saw. It was rated very high. It's a rate of return of about 14%. Now, I didn't have time to run the cost basis on that fund, but I'm certain that it's a little bit lower than that. But the fee in that account was 50 basis points, so 0.50 in that particular fund. The other fee was 0.77. So I actually used that in my example to get the $30,000 of difference, but that's only 18 years. And now that doesn't give the fund credit for seeking alpha, okay, in excess of rate of return. That's comparing the 2 apples and apples as far as the rate of return. So I want to be fair about the comparison and say that if you're going to pay that extra expense and wash that fee, for a lack of better terms, it better be providing you that over and above average rate of return to justify the expense, because you're going to pay for it over that time. But the what if, the unrealistic portion that I typically don't like, and the misleading part about running through a compounding calculator estimation, is that in real life, you just don't get a guaranteed 7% or an 8% rate of return every year. It just doesn't work that way. It also typically doesn't work that way if you don't have yourself set up on a dollar cost average program every single month. A more realistic approach is is one that has you putting different amounts of, or injecting different amounts of cash. I've done videos on this before where I'll take my entire tax return and either put most of it to cash or use that to fund my retirement accounts. But typically a compounding calculator is going to allow you to put a value in there of, let's say, $50, $100, $150, $200. So you can pick whatever amount that you want in there to kind of figure that. The question you need to ask yourself is that really indicative of what's going to come out of trench warfare? Okay. I mean, the volatility in the stock market this week was a real give back. I mean, it was awesome. I took a $5,000 swing to the positive. I'm not complaining. Okay. It was a good birthday gift. Had I been down $5,000, I probably would have felt the same, but I'd rather be on the other side of the coin. Having a nice appreciation value. Took a couple swing trades this week as well, which I'll disclose to you guys tonight. I do want to take the opportunity as closely as I could to within the first 10 minutes of the live stream. I'm after that right now, but I do have quite a few channel creators in the group here. Awesome, helping support the community message that we're putting through. I love it. Thank you very much. I appreciate you coming and spending your time with us on the channel. I got Lydia Santiago here, J Mac Investing, Mr. Jason is in the group, and you guys can certainly feel free to hit those guys up as I'm facilitating the discussion, because I do really want a lot of the discussion to really revolve around you guys looking in the mirror. Okay. And if you need to come on to the Independent Investor channel and have a guy like myself at 42 years old sit across from you, some of you guys are older than me, others of you may be making your way into the group in your late teens. If you are, why don't you do yourself a favor and keep it going, because this has the potential to change your life. May prompt you to think about things that you haven't thought about yet in your life. So take it from somebody that may just have a little bit more wisdom on you and has been around the block a few times, because rest assured and for certain, I have. Okay. So keep it tuned in, and maybe you'll learn a little bit on this Friday night as opposed to some of your other activities that you may be doing. I know I was. All right. But I've got Brent in the group here with the Financial Investor as well. I've got a couple other channel creators that popped in. Actually, first thing, Stock Market Investing is in the group, and I've got Investing with Aaron as well, who popped in here at the very top of the live stream. So good evening to all of you guys. If I did miss somebody as I'm cruising through here, you guys are all friends of the family. I do apologize. I don't mean to leave anybody out in the cold. I got Gen X Dividend Investor also in the group here. Appreciate you making your way in. I see some first time icons here, and I don't know if you guys are first time to the live stream. I've got Art Brigida in the group here. Awesome. Happy birthday. You're awesome. Very knowledgeable. I'm very experienced. Okay. There's folks in the group like Ernest. Ernest is in the group as well. Try not to use his last name just to protect his anonymity over the group, because I do appreciate. But if you want to talk about somebody who's knowledgeable and downright brilliant, Ernest is one of them. I think I resonate with those folks who do have some experience. I've got some trench warfare under my belt here, and I've been able to draw what I consider a lot of experience in the market, and knowledge through experience means a lot when you're investing, because quite frankly, those folks that have a lot of knowledge about the stock market, you can't outthink the stock market. You really can't. And that's one of the key principles, is when a lot of these new investors tune in and they hear a guy like myself sum up investing in one quick scenario about investing in the S&P 500. And it basically gives them that framework of financial security into the future. Now, I don't know with inflation what $125,000 is going to mean, but it's nothing to shake a stick at just for taking the few steps. I mean, you could be set up on that program in a couple days. Okay. And if you were disciplined in that approach and you really heard me out, okay, that's coming from experience and not necessarily the knowledge portion. And a lot of young kids that get involved in the market now, unfortunately, think that they can just outthink the market. And I think that can be a real learning curve for a lot of folks to get over. But I think as quickly as you can kind of make those mistakes and get them out of your system, you'll probably be better off in the long run. Before we get into the stream itself and some of the things that I do want to talk about, some of the scenarios that I did up for myself, I do just want to continue to come back to the theme of always looking at yourself, knowing why in fact you're doing what you're doing. The scenario-based investing is always putting your portfolio to the test. And there's no perfect portfolio out there. I've said this many times, but at least have the fortitude to run your portfolio through a stress test, for lack of better terms, okay? Be honest with your holdings. Be honest with what you're trying to do with those holdings, okay? Are you trying to establish some dividend income into your future? Are you trying to establish some financial security? What are you going to need the portfolio to render at some point down the line? Those are some of the rhetorical questions that I expect you to ask. And certainly a lot of people bounce them off of me, but it usually generates a lot more questions than answers if you're asking me the questions. And it's so much better if I can just say, look, ask yourself that question and then line up the half a dozen follow-on questions that usually should come after getting a clear idea of where you're going into your future, all right? So I'm going to show you what I was sent. It was pretty cool when I opened the box, but I'm going to start with the conservative stuff first, all right? Now, this is right from the Northwest, and you can see how simple of a guy I am. But this is albacore tuna from the Northwest, okay? Now, if you don't think that there's a difference between this and bumblebee tuna, you are off the rocker, okay? Northwest, man, that's where it's at. This is a beautiful product. You can buy it right off the boat. But this company right here sells it, and I got it shipped to me today. Pretty stoked about that, okay? Now, next, if you're from the left coast, okay, you can appreciate Dungeness crab, okay? So we got some Dungeness crab as well sent to me, so I'm super stoked about that. Gotta have some Pacific shrimp. All right, got some of that. All right, and my mom sent me crackers with it too, so I can have some of my seafood with the crackers. Now this is kind of where it gets interesting, okay? For all you home gamers out there who really love a good delicacy, yeah, get a load of that. Smoked oysters, yeah. All right, man. See, this is how we roll in the Northwest, man. We go over to the coast and buy a bushel. See, for the folks that are actually from the Northwest, they can speak my language. They know exactly what I'm talking about. You go buy a bushel, throw them on the barbecue, let them split open. Yeah, a little bit of butter, a little bit of Tabasco, a little bit of soy sauce. Yeah, you know what I'm talking about. All right. And then I got a little bit of Chinook salmon, okay? For the layman, it's king salmon. All right. If you don't believe me, trust me. All right. This was my old job in another life. All right. And then finally, I got some smoked sturgeon. Yeah, that's what I'm talking about. So I was pretty stoked. So if you're looking for some good gift ideas, I thought it was super unique, and I'm a hard guy to surprise, but I thought that was pretty inventive, kind of a cool thing to send to somebody who seemingly has everything, which I do. I really do. I'm very, very content, but I'm also very, very reflective. And it certainly is times like these, typically talking about myself, not really my favorite topic. I typically really like to focus on the success of others and helping others. I'm addicted to it, to be honest with you. And certainly some of the folks that can make their way on that are a little bit younger in life maybe and aren't asking those reflective questions just yet, maybe they can pulse in with somebody like me and go, wow, that's pretty awesome, man. He's talking about some pretty killer stuff, life-changing stuff, to be quite honest with you, because in about a 36-second time span, I gave you $100,000, okay? If you're young enough, 40 years, zero starting capital, $50 a month for 40 years renders $128,000, with $25,000 of that being actual contributed dollars, all right? So real stuff, man. If you're 18 years old, pretty important stuff. to keep in mind. So let's kind of get to some of the folks here. Again, thank you for tuning in. I really appreciate you guys making your way in. Got some really good friends of the channel here. I can see I've got Noella in the group here. She says, yum. That's funny because I'm not really sure. Oysters typically turns people off, but hey, whatever floats your boat. I've got Doug Whitaker in the group here. You're all set for Sunday NFL, Ryan. I am. That is correct, but I'm not going to eat it all at the same time. But I got Rock, no seafood. That's funny. He's from Oregon too, man. It's a financial investor, man. He doesn't like my program there. I got Avier. Oh yeah, that's all good stuff. Real canned tuna from the Northwest is amazing. I live up in Mendocino, California for a few years. You betcha. It's really good if you buy it off the boat, can it yourself. That's the only substitute to the products that I've got here. So pretty cool stuff. Whoa, crab in a can. What's the company name? Company's name is Chuck's Seafood. Troll caught. So that's good to know, man. They're trolling for this stuff. No salt. Chuck's Seafood. So you might be able to Google it and check it out. He may have a, those businesses over there, pretty cool stuff, actually. I got J Mac in the group. Hope everything's going well for you, man. I haven't talked to you in a little bit. I've been too blocked at work. Obviously, we've had an angry Mother Nature rolling up the entire East Coast, which has consumed my week this week. So this is a little bit of a relief. I'm trying to thread the needle here and offer this particular live stream because I thought it was pretty important. It's amazing, 63 live streams into it, and we really haven't revolved around this topic very much. Hopefully you guys find some benefit out of this reflective type of idea, asking these questions. What are some of the mistakes that some of these savvy investors have made in the group here? What would you have done differently if you could kind of go back and maybe do some things differently? And it's funny, we all know that that's not possible to do, but certainly to gain some wisdom of some folks that have been there and done that, that's all fair game. Absolutely. So I think you can get those cans in SeaTac. Nice. Investing tips and tuna tips. Yeah, no, just having a little fun tonight. Why not? You guys know I don't script these videos at all, and quite frankly, I don't need to. If we're keeping the conversation based around some of the nerves or the commonalities of investing, and exploiting some of those commonalities, because a lot of folks in the group, they do invest on their own. And it's kind of cool when you start identifying some of the things that work for other people, because I have a lot of scrutiny that's put on my self-directed portfolio a lot. Okay. I took some swing trade positions this week, bought back into two of them, Alibaba being the top one, Baidu being the second one. Those are just the two that I find the most value in, to be honest with you. I took a nice profit in Alibaba. I owned it one day. So took some profit, swung it. All the rest of the long positions remain in the portfolio, growing as they do. The sector portfolio is working, doing its really well. The first trade account is approaching that $5,000 mark. So halfway to our $10,000 goal. I'm satisfied with that. I have not moved anything in that portfolio at all. It still remains intact. I just have added positions to it every month. With the first trade account, and then the M1 Finance as well is extremely passive. I haven't done anything other than fund that account with $25 a month there. And it's interesting because I mentioned that opportunity for the S&P 500, the VOO for young people. Most of those sector spider ETFs have returned about 9 to 10% over the life of each fund. So I've kind of got a little bit of an experiment going with that M1 Finance account right now, to see how good that performs, to see how rolling those dividends back into it compared against the capital appreciation within that account is working, and I'm very pleased. It's very defensive in nature. I've liked how it performs, and I like the fact that I can just kind of set it and forget it. But for the other accounts, all the long positions are still good. Those are still intact. I did take some profit this week. I don't have a stock market week like this week without taking the opportunity to render some profits in the account. I did end up liquidating my Kroger position. That ran up. I took a nice profit out of Kroger. I did shave back some of my industrial exposure. I wish I didn't have to, but Northrop Grumman, I sold that for a nice profit. I think that was a 14% profit in Northrop Grumman. I wouldn't have sold the stock, but I did it for portfolio rebalancing. To be honest with you, I was a little bit heavier than I wanted to be in the industrial sector. Took a position, a one-day position in Facebook, and that was 2 days ago. Sold that yesterday. Good on that one. But took a little profit from Facebook. CRM Salesforce, same thing. Bought that at the beginning of the week, took a little profit off of that, and I think that was about it. No, I did enter into a new position to bump up my financial exposure in Prudential, okay? Ticker symbol PRU. So for all you home gamers out there that are kind of keeping track of the insanity that does exist within my portfolio, we are manufacturing quite a bit of profit, and I do use the $225,000 base position to figure my numbers as I'm 42 today, and then my target date of 59 to retire. So that's where I figure that. I think it shot me somewhere in the range of $925,000, something like that, and then just adjust the contribution a little bit. That's with a conservative rate of return of 7%. So we're still looking like we're on track. We're fine. There's nothing that I can do to tell you what the future is going to do, okay? Nor is there anything that anybody else can do to tell you what the future is going to do. All we can do is use the tools at our disposal to kind of ask ourselves, what if, okay? What if the historical returns keep up in the market? What if I'm able to make this 7% rate of return year over year? What's that going to look like for me in the future? And there we can run those through those tools and render those answers for ourselves, okay? I did that right before the live stream because I thought it was very appropriate for the conversation tonight. Okay, so we'll talk about compounding interest and smoked sturgeon. Okay, good stuff. Jen, great advice. There should be no sacred cows in your portfolio that you can't shed. It's an interesting perspective. It's an interesting way of putting it. I'm not sure if I agree wholeheartedly with that. I know what your intent is, and you're 100% correct, okay? I don't get married to the stock market. As a matter of fact, it's a love-hate relationship if you want to know the truth, okay? You know, putting thousands of dollars into a few shares of stock, whether it be 10, 50, 100, maybe even a couple hundred shares of stock, anybody that's sane may look at that and say that's insane, because they don't know exactly what your legal authority and ownership over those shares means, okay? And it does definitely benefit you to have an understanding of why you take a small ownership stake in a good quality company, okay? That's a different lesson for a different day. But here's the thing. If I comb over my portfolio, I typically, my eyes will jump right over Disney, okay? My eyes will jump right over United Technologies. My eyes will jump right over 3M. My eyes will jump right over Boeing. What do I mean by that, okay? My eyes jump right over Costco. These are holdings in my account that, by a lack of better terms, are my sacred cows, to be honest with you. And I think it does help separate your portfolio in a lot of different segments. Okay. Now, if you're just a dividend portfolio builder and you just buy into your portfolio to get you that dividend income over time, I can understand that, but you're not selling stock either, right? You're not looking at certain dividend names that have increased their dividend for the last 10 years and looking to shave those positions off. You're looking to accumulate positions and hold those over the super long term, because you can figure how much dividends are going to be paid to you over 10, 15 years, where those can help you actually buy the stock that you've entered into that initial position in. Okay. But when I talk about taking a short position in Facebook, it's a twofold position. Okay. I'm fully aware that if I take a position like that, I need to take it into deep water. I just got a nice $4 upswing in the stock. Took a $120 position. I get free trades in the account, and I did it. Okay. That's a perfect example of not having any type of emotional attachment to a stock. But I'm going to be honest with you, the JP Morgan Chase in my account, the starting position in VTI, VOO, VYM, my small cap ETFs, those quite frankly are anchors in my portfolio, and I don't intend on selling those at all. SPHD. And it's interesting, that comment, because I know exactly where you're coming from. I really like the perspective. As long as you understand that, quite honestly, guys, we can come in here and talk all until we're blue in the face every Friday. But some of the best ways of succeeding in the stock market is just buying it, sitting on it, and forgetting it. Honestly, you can have feeling about it. You can be emotionally attached to it. But quite honestly, some of the coolest investors, and it's investors that don't come into the live stream every Friday, some of the coolest perspectives that I've heard are from people. I had a perspective from a lady who told me, Ryan, it's been 30 years since I've sold a stock, and it's made all the difference over the long term. All she did was buy large cap quality companies 30 years ago and just held them. And she's a millionaire now. Millionaire. No trading, no manufacturing, right? Does this sound familiar? It's all stuff I do, right? So if I'm going to look in the mirror and be critical and say, wow, that's an interesting philosophy, thank you for sharing, but there's a lot of value there, you know? Now, for you young folks out there who have the power of the internet, I'm not going to sit here and tell you that there's not a lot of money to be made by manufacturing money. I'm just saying, be careful. Okay, be careful, because it goes back to what I was saying about a lot of young people who make a couple stock trades and now they're automatically Gordon Gekko, and they think that they're the God's gift to stock trading, and that doesn't exist. Okay, so just be kind of careful. All right, not everybody can be like the one and only Doug Whitaker. Why? Because there's only one of them. All right. So take heed and notice, man. When he comes in the group, you can ask him questions. Just don't get too close, or you might get burned. All right. I hope you don't mind me using that, Doug. Just roped you in on your stock trading, but he would agree with me. I mean, we're trying to scale an approach that's appropriate for everybody. Okay. So it doesn't do me any good to sit here and tell you that you can't have some success doing that. Okay, you can. But I don't know if it necessarily applies to the masses. And certainly there's a lot of people out there, and people that I've talked to, who just have an absolute affinity to or are completely against single stock investing. And that's totally fine too. If you want to go ahead and grab that diversification through ETF or index investing or mutual funds, whatever suits your fancy, go ahead and do so. That's fine. There'll be enough fundamentals that you pick up in self-directed investing to allow you to give yourself that strategic edge. Okay. So, things that you can't control and things that you can control, it's really important for you to understand that rate of return that's annual, you probably aren't going to be able to control that. Okay. So when we talk about an unrealistic versus a realistic scenario, week to week, month to month, year in and year out, you're gonna subject that portfolio to some volatility. Okay, and there are going to be times when you're going to look at it and go, man, I don't know if I can do this. This is kind of wild. Jesus. I mean, that guy seemed really, really fired up on last Friday. And here it is Tuesday. And I feel like I'm on an island all by myself here and the market's down 600 points. What's going on, man? I didn't sign up for this. Reality. Okay. Reality. Okay. The unrealistic part is when you think that everything is guaranteed. And there's nothing guaranteed at all. The rate of return is definitely one of those things that is not guaranteed. We have to rely on historical precedents to give us some sort of an idea of what you can realistically get out of the stock market. My rhetorical question for you is, would people even invest if it wasn't worth it? Okay. Christopher Blaine hit me up and has said his wife is kind of on him for spending a lot of time with the investing topic. Okay. And I posed the rhetorical question back, wouldn't it be a lot more scary to think about your life if you didn't have investing at your disposal, right? Those are some of the questions you need to ask. But then we start to separate some of these things that you absolutely can control. Okay, you can. There are certain things that even though people will come into the group and they'll be like, I can't do it because I don't know where to start. I don't have any control. Yes, you do. Give me a number. Okay, give me a number. That number is going to come in the form of your contribution amount. And I just gave you at the top of the screen, if you're 18 and you just happen to come across this live stream and you're like, God dang, that guy just told me I could invest $50 a month, which when I was 18 was a lot of money. Okay. I started with $25 and I had a full-time job when I started investing later on in my life. Okay. I really didn't start investing seriously until I was about 26. Okay. Now I had my head up my backside up until then. Tripped, fell, stumbled. I didn't know how to invest. Okay. That was really about the time when I started to get serious about dollar cost averaging. Okay. So I started with $25. All right, that's an amount that I can control. That's your contribution amount, okay? On the flip side of that, which is where I come in, okay? And this is one of those things, again, you don't have to tune in and say, wow, Ryan does this. I have to do exactly what Ryan does, okay? You're missing the point. If you get the point of this lesson right here, you absolutely can electively control the amount of expense that you're willing to accept within your investment account. Very, very important. And that was the essence of Christopher Blaine's question for me. Hey, I put this in a rollover 20 years ago. It's done what it's supposed to do. It's compounded over time. Boom, now I'm sitting on 40 grand, right? What do I do? Those products, they just rolled over maybe into a couple of products that maybe the advisor said, hey, here you go. They're good funds too. The one is rated fairly low, the computer specific, the hardware fund that I looked at, higher expense, 77 basis points in that ticker symbol. You guys can check them for yourself. Chris left them up in the thread, but 77 basis points on the one and 50 basis points on the other. And they've still performed very well. I think they've both got average rates of return of over 10%. That's why I wanted to be fair about your question about swapping them into some lower fee ETFs, which you can certainly do. That's a perfect example of taking a fairly unacceptable level of fee, even if you are getting that outperformance, and swapping it into something that's guaranteed low expense and give you something that tracks or mimics the market and doesn't go after that alpha. Because if they're trying to manage that in a very specific way, you're probably taking on a little bit more risk than you need to actually gain that alpha in that particular account. Okay, so that would be some of my concerns there. That's why I hit you with the question of starting a dividend portfolio, which it sounds like he's already done that, because there's already an existing 401k that gives that baseline. So you can give a nice ability, let that grow over time, and then start those other accounts and give a nice supplement to your already existing 401k. All right. So really good stuff, man. I'm going to kind of work up here. That was a great comment, by the way. That was Dividend X Investor. I think we had a good discussion last week as well. So appreciate that, man. Very cool. Good. Awesome. Ryan's the best. Happy birthday. Yeah, I guess so. I'm not a big birthday guy. I did about as much as I could. My daughter did a great job tonight. Just a great job. It means more to her than it does me. But it means a lot to me that she cares so much, for sure. So it was really cool. Anyway, good Greg, Cami in the group here, the one and only Doug Whitaker. I'm sorry to hear about your mother. Yeah, prayers for her and your family. I concur, absolutely. That's aimed at Doug for sure. Doug's one of my brothers from another mother, for sure. So heart goes out to you. It's been a rough week, no doubt. Geez Louise. And we had the Bahamas get destroyed this week. And, here we are coming together as a community, talking about, our perspectives and on finances. But I do certainly acknowledge that sometimes the conversation does and sometimes needs to go beyond what I feel like is somewhat of a shallow topic, to be honest with you. It's something that people should have more awareness on. But quite frankly, investing should just be a supplement to your life. It should just be a supplement at best, no doubt. Do it as much as you need to do it to understand what you need to do to succeed in finances, and then try to fill up the rest of your time with something else. Okay, there's some heartfelt knowledge from the Independent Investor channel. I'm glad to render it. Like, eat some smoked oysters. All right, it's good for the spirit, baby. Do it. Jason right here watching and enjoying good stuff. I took some more profits. Smart. Market is news driven and not rational at times. I don't think it's rational right now at all. I think this whole dynamic about the Fed's involvement right now, I don't really share in the sentiment that the Fed chair should have taken a different route in the stock market. Quite frankly, I didn't hear a lot of reservation when rates were raising. The criticism came after the market started to kind of level out a little bit. And I think working off of manufactured and they were manufactured low rates for such a long time, I really do think it was the prudent move to raise those rates up and not just raise them so slowly to let the stock market overheat itself. So I'm actually happy, but that's what makes a market, guys. So Bob Wright says, I took profits. The market is news driven. I did as well this week. I did put some profits aside. Still, of course, a bulk of my money is invested. Certainly S&P 500. Passive investments, some great dividend ETFs. You guys know the majority of my holdings right now are passive in nature. I do hold a lot of exposure across the board, multiple buckets. So that's just what I've got right now, positioned really in a manner that, if I can use an analogy, I'm kind of like a rattlesnake under a bush waiting for the rat to walk across the trail so I can strike. And if I have to continue to wait, I will. I have a feeling that we're not going to have to wait too much longer. The market just doesn't feel like it, with the global economic situation going on, with the credit crisis, and I do call it a crisis, which is ignored way too much, is extremely looming, and it's concerning to me. And I have the right to have my opinion. And, me as a household of four, and a lot of you guys can attest to this, if you get in debt $10,000, you're going to have to pay for it some way or another. Either you're going to declare bankruptcy and it's going to get scrubbed, or you're going to work extra and you're going to pay extra to pay off that debt. I'm not really sure I understand why the federal government is exempt from those very rules, okay? I would like to see that cleaned up if I'm going to have 100% confidence in investing in, quite frankly, the majority of my assets are centered in North America. So I would like to see that cleaned up a little bit, because right now it's garbage, if you want to know my opinion about it. So anyway, let me cruise up here and try to pick out some of these. I've got Clarence Lampkin in the group here. I think it's the first time I've seen Clarence, and I don't know if you've been with the channel for a while. I'm on kind of a hiatus right now, so I'm doing my live stream every Friday. I will be doing my technology upgrade this Sunday, and when I re-engage back on the channel, you guys are going to see a little different approach. I'm going to attempt to streamline my efficiency and allow myself the opportunity to do some daily uploads, some daily opinion on what it is that I did. I mean, I traded 2 stocks today. That would have been newsworthy to come on to YouTube and provide that opportunity to the rest of the YouTube community. But for the live stream, this is what I enjoy the most. So I do thank you for coming on. Lampkin says, keeping me educated as I run my daily round trip to Omaha. Awesome, man. Thanks for all your knowledge. So if you're a truck driver, okay, I've got a special place in my heart, man, no doubt about it. If in fact I don't want to contend that I know, because you don't come out and say it, but if you are in fact out there on the road, be safe. It's awesome. It's great to have you tuning in, and you know, it's cool to be representing just a little piece of those hearts out there, folks that are out there working, perhaps maybe away from family, perhaps maybe not, maybe they're supporting their own initiative, and that's great and plenty. And that's honestly why I contend that this topic is in fact infinite, because that's where I keep a lot of the focus for my group, on them and not me, because I'm not that interesting. Cool. All right, cruise up here and try to get to some more of these. 84, definitely rough. That's a good life though, man, for sure. Doug, for sure. Yeah, you betcha. I hope I make it like that. I hope I make it that long. 40, I mean, I'm halfway there, man. Yeah, it just makes you think about your own mortality, and really doing your best to do it right, or at least as close to right as you can, for sure. So anyway, 62-year-olds watch you too. I got a lot of folks that tune in, you know, in their 50s, 60s, and I think it's phenomenal. I've had a lot of folks in their 50s, 60s, 70s, 80s reach out to me and be like, hey, have you thought about this? Have you thought about that? And if I were to come on here and contend that I'm somehow the same investor now that I was 3 years ago when I started this channel, I'd be lying. There's no way. I'm collectively way better by bouncing ideas off, getting perspectives from other folks. I mean, I think I picked up SPHD when I was watching a Joe Carlson video, and then I was watching a JMac video as well, and saw that these guys had picked up that. And I said, okay, well, I had my head wrapped around the axle with Vanguard, kicked over, checked it out. I liked the product. It fit strategically in my brokerage account. So I took the position, and I will benefit for it. That's a real tangible benefit. So for those people who say that you can't benefit from watching YouTube, all right, you better check your compass, okay? Because there's a lot of people out there. And I think collectively on a topic like this, we're probably better than we are as individuals. I know there's a few people in the landscape that probably think that everything that they say is gospel. I'm here to tell you that's not true. Some of the few channels that I really do like, I do put a plug in for Nate O'Brien. You know, some of the folks that were some of the original folks. I think Joe Carlson is probably one of the best, in my opinion. I love his philosophy on investing. Just a great example of somebody who takes his own strategy and makes it work. And that's part of the between the lines, is learning how to take your philosophy and make it work for yourself. Understand very, very specifically what those items are that you can absolutely control, right? And I've watched Joe's videos, and some of the things that he can control is his ability to do research. his ability to stay in his swim lane with his program, his ability to allocate his cash the way that he wants to allocate his cash. Now, I think he's a little bit too conservative. That's just my assessment. And I would tell it to his face. I really would. I would want to ask him, what's your thought process? Why is the majority of your money in a taxable brokerage account? And I think I would know the answer. It gives him the freedom and flexibility to contribute as much as he wants. That's cool. But he's kind of got some money asleep in his Roth IRA. And I would contend that that's probably something that I would look at fixing. That's just me. It doesn't mean it's right or wrong, but some cool stuff out there on the landscape, but making some real differences for people if you're willing to listen. Absolutely. So Hector Mendoza's in the group. Says happy Friday, everyone. Hope everyone's having a great day. It was busy, not only day for me, but a week. Like I said, it's looking like I may end up threading the needle here with this project, which is a good thing. Good stuff. Been going a little less than an hour, guys. I'm going to go as long as I can because I feel pretty good and I was excited for this message. Dividend growth. Yeah. Hi, Jason. 42 years young. I hope you're talking about me. As I do. I've got a lot of people that tune in that are across the spectrum, and there's a reason for that. It's because the message really is appropriate for a lot of different age groups. Okay. And I like the idea of somebody that's in their 60s, 70s saying, man, I had this guy on YouTube talking about this reflective questioning. And, I've got a couple grandchildren maybe that are starting to invest. Maybe I've got a couple children in their 40s that have never even thought about investing. Maybe they need to be tuned on. Okay. So maybe I earn a little bit of referential opportunity there with those folks to introduce something new in the investing landscape. So really good stuff. All right. I've got Sarah Logston, who's actually super loyal subscriber to the channel. Has been with me an awful long time. I have a funny memory, and the funny things that I remember are funny. Okay. I think I remember when you started with us. So happy birthday from traffic on I-5. Oh God, I was born under I-5 in Roseburg, Oregon. Look it up. You betcha. I know. I don't know how the heck you're dealing with so much traffic on the left coast. You should try coming on over here to the East Coast and check this madness out. It's ridiculous. All right. Try driving in Washington, D.C. For anybody who's ever tried that knows exactly what I'm talking about. It's absurd. All right. Good stuff. It's nice to see you in here. Yes, I've been bolstering my cash position. Happy birthday. Hella hugs. I'm sure there's more to it than that. I will just comment. I'm sure there's more to that comment, but I think it's a good idea at this point. S&P hitting record highs, butting up against those record highs, to again continue to just acknowledge the importance of your cash pillar in your program. Okay, very, very important. Don't lose track. Don't let this market blind you to the prospects of how raw it can get and how quickly it can get there. Because I think we're probably moving in that direction. I really think so. All right. I'll go until I lose my voice. All right. I don't have my typical libation to help me, but I may be surprised because I don't want to fall off my chair after 2 hours of the live stream. I may surprise myself. What the heck? You're early, Lydia. She is. Does anybody use the new YouTube studio to set up their videos or the old? I use nothing but the old one, just to answer your quick question. I hate the new one. I think it's silly. So, but I was happy to stumble into the merchandise section. I'm happy with the merchandise, and thanks for everybody that actually took a purchase on the merchandise. I appreciate the support. That helps a lot. I'm happy with the clothing. It's cool. All right. Guys never hit 30 over and over for 10 years. Happy birthday. Thank you, Lydia. Appreciate you. The call out. It's great. It was a good day today. I worked from home. It was lovely. So I got damn tanks. I shifted my TSP from 100% 40 to the Paul Merriman 2 fund strat of 69% L50, 21S, and 10C. Anyone have any thoughts on the setup? I think it's defensive. I think it's good. Interesting enough, though, depending on your age, right, your contribution in your L50, I would want to make sure that that's not heavier in stock now to try to push out that retirement date until 2050, because at the market at its current high, you just make sure that you have the proper time frame to go through at least one recession in that section. That's kind of one of the things. I really like the life cycle funds. I think it's the cheapest managed option that you could possibly have. A lot of people would kill to be part of the TSP because it's that good. I mean, it's basically a perfect portfolio. I like your idea. You're probably a little bit redundant, okay? Owning the 69% in the 2050 and then owning S and the C on top of that, because you've got, allocation already to the S and the C within that 69% in the 2050, and also the 2040, okay? So just my thoughts. You do have some overlap there. If I was going to give you some criticism, which is why I think you asked me, and I don't blow smoke at people either, but I always, it's the first time I've really seen somebody utilize the life cycle and the self-managed, the individual funds itself together like that. I typically like to see folks do either one or the other, because those life cycle funds are really meant to be a one-stop shop. Jam all your money in there and let it roll. Let it adjust over time. Let it tax loss harvest. Let it rebalance. It does that for a very low fee, and you're kind of good to go. I don't know. You could come out a winner, but I'm not sure if you're not trying to outthink the TSP, which it's so simple. But when you start doing stuff like that, it starts to be a little bit confusing in the sense that you may outpace and you may also underperform as well with that allocation. So those are my thoughts. That's a heck of a question. I thank you for posing it to the group, because I know there's a lot of TSP owners that tune into my message. I will tell you right now, I do have exposure to all 5 funds in the TSP. 70% of my money with my age, okay, I render that appropriate because with my aggressive profile, which it is, some aggressive profiles that talk about investing over YouTube, I would put in the insane category, okay, not aggressive, okay. But I do have 70, 10, 10, 5, and 5. 70C, 10S, 10I, 5F, and 5G. Okay? That's what I've got. That's my exact allocation. That's what I have. And my contributions, majority goes into the C fund, the S&P 500, because that's kind of my flagship passive S&P 500. I have one in every one of my accounts. And that's just how I like to do it. But the contributions every month that go in there, I contribute 10% of my pay. So $1 out of every $1, $1 out of every $10 that I get paid goes into the TSP. So that's what I do. Okay. So good question, Dan. Thank you for popping in and offering that. That's good stuff. It says, cheers, brothers. Victoria, Victor Hernandez in the house here. PFE here as well as AbbVie. I own them both. Pfizer is one of those that, back to alluding to not getting married to certain positions. I've never had a problem with taking profit in Pfizer. I wish I could go back and I could probably make a video of chronicling my trading channeling of Pfizer, because I have absolutely knocked that stock out of the freaking park. No doubt about it. I have absolutely killed it with Pfizer. Right now I own it, 50 shares. That's the position. ABBV, I got in a little bit early, took it into a little bit of deep water. It's coming back. I'll rake in the monster dividend. It is a dividend aristocrat. interestingly enough. So I'm glad to own it. I'm a little underweight healthcare anyway, so I do own other positions in J&J, United Health Group I own, Johnson & Johnson, you guys know, in healthcare, and as well as Medtronic, which is probably my pick of the year, to be honest with you, up 17%. And another company that I'm extremely satisfied with, and I'll just continue to hold in the portfolio. There's no reason to take profit there, no reason. So that's my healthcare exposure. Good stuff. Appreciate you sharing. I agree. I own them both. All right. Picked up more Pfizer this week. Andrew Ryan in the group kind of validating what I'm talking about. So, you know, if I looked at, I think right now I'm probably a little more aggressive than I want to be in General Electric. But from a percentage perspective, I never get so overweight in any one position that it's not more than a few percent when compared to the total overall portfolio. All right, just a couple percent. And a lot of my holdings are way less than 1%. Okay, to just let you know kind of how I spread the wealth around a little bit. Okay, since you're on call, Ryan, I will drink a cold one for you. I would appreciate that, Victor. Thank you. I appreciate that. Awesome. All right. Evening. Happy birthday. Appreciate it. Got Mr. Jared Odell, good friend of mine in the group. Great to see you, man. It's great to see you. Thanks for popping in. Thank you for all the support of the channel. I really appreciate you. Art Brigida, happy birthday. You're awesome. Very knowledgeable. I've already responded to that comment. Thank you. I appreciate it. I don't know how much longer I'm going to go. I'm kind of coming down with something, so I'm fighting to deliver a good message tonight, but I really want to drive home the purpose of this particular lesson. So when I was running my numbers through the compounding calculator, I really cannot stress enough how important that is for each and every one of you guys, except for Doug Whitaker, okay, to go into the compounding calculator. Doug Whitaker's already retired, so he doesn't need to do this, okay? He's a multimillionaire. He does not need to do this. He's exempt, all right? And he's probably laughing right now because he heard his name and I interrupted his football game, all right? But for the rest of you guys that are into long-term passive investing, highly encourage you to kick over to the investing calculator, okay? And based on your age, if you're 32, all right, add 25 years, that puts you into 57. 27 puts you at 59. My target retirement date is 59. This is not rocket science, guys. It's very, very simple. If you're in your 50s, 60s, 70s, you can play the same game as me, okay? I don't know what your goals are. If you've never invested before, but you have a $500,000 house with $300,000 of equity, you're still doing quite well. Wealth comes in a lot of different forms, okay? And trust me, 70% of people who own a Mercedes-Benz lease them. They lease them. They do not own them. 70%, okay? So make no mistake about it. We do not get caught up in pipe dreams. We do not get caught up in the facade of wealth. We are interested in creating real wealth. Yeah, real, okay? Real wealth, okay? The guy in the sweatshirt can actually go pay cash for an $80,000 BMW. I just choose not to, okay? Because I'm not stupid, all right? We're creating real wealth, real wealth. Go into the compounding calculator. If you're 32, you've got 27 to 59, you've got 30 years to 65, etc. Whatever your time horizon is, and you're going to need to render your starting amount. If you're starting with 10,000, if you're starting with 1,000, if you're starting with 0, okay, run yourself through that exercise and start to put pen to paper with regard to where your numbers shake out, what you could actually realistically achieve into the future. And you can start to do some of this stuff because you've actually deployed your control over some of these things here. And this is where a lot of the value on the independent investor channel is rendered, okay, is that a lot of people don't know what they're losing here, okay? And the real tell is when you run it through the compounding calculator and compare the scenarios. Compare your real scenario. It's very simple to jump into your retirement accounts. And if you own an ETF like a VOO, you all know that the expense is 0.03. It's not any more than that. It's not any less. That's what it is. But if you're in a managed account, there could be fees attached to that account that you do not know exist, that you're having to pay, whether or not you're conveniently naive to that fact or you are aware of that fact, okay? But you need to be aware and take account of that when you're looking at this expense piece to it, okay? And you run those numbers. If you're that 19, 20, 21-year-old man, this information's golden, and you'll be the ones that are the most susceptible to turning this message off, okay? All the folks that are actually in the community here, Jason and Brent and Dave when they pop in, and Nate O'Brien, all those guys in the community, Ryan Scribner, all those guys need to really be paid attention to. They really have a lot to teach. And quite frankly, Nate and Ryan, for example, they're both young guys, especially Scribner. Jesus, I think he's 23 now. Wise beyond his years, okay? And those are the folks really that you should gravitate to, those folks who are really grounded, but don't mind sharing some of that expertise with you guys. And certainly if you want to come in and listen to me rap about my experience, not knowledge, in the stock market, you're welcome to come in and do so as well, all right? I would highly encourage you to stay tuned to the Independent Investor channel, because we will be ramping things up as we approach the year's end 2019. And I have a feeling that there's a lot of new investors out there who are going to need my services free of charge, okay? They're going to need my perspective, because here's the thing. If you think I'm good now, wait till the stock market starts to get cranky, okay? You're going to hear a different perspective from somebody like me. And I think a lot of investors on YouTube are going to be stuck with their pants down. That's what I think. All right. Good stuff. I'm an engineer, flight control, Chris Blaine. Awesome. Yeah, he's doing really well. Sounds like I missed by calling. Hero live stream catching a month. You're doing great, Christopher. Hope you're not robbing banks. Oh, man. That's funny. I paid my fair share of taxes. And then there's the thread with Chris as well. In the top. Let me cruise on down to the script here. I've got Adriana Aristobal from, I thought that thing was going to hit you guys. I really did. I'm glad that it didn't, but hearts go out certainly to the kind folks of Bahamas. They really got hit with a natural disaster there, no doubt about it. So, but it's good to see you pop in here. Stephen T has also joined us in the group here. I'm going to cruise all the way down here and see if I can't catch some of the new stuff. I've got Daryl Rika, who's been with me for quite some time. It's great to see you. It's just funny, out of the folks that come in and the folks I remember, Daryl's been with me for a long, long time. So it's really cool to see you. Thank you for coming on. Larry Massis says Medtronic. Again, it's probably the stock of the year for me. Up there with Visa, no doubt. Visa's just been an absolute just firestorm. And it's amazing. Each and every stock has its own, personality. And I've sat on the sidelines with some of these stocks that I just watch every day, Roku, and just watch them go up every single day. It's not in my profile to jump on every single opportunity. But if you monitor the stock market long enough, you're going to identify that there's a lot of opportunity there to do quite well. Okay, again, that's the allure of the stock market. There's an infinite amount of ways to succeed. Unfortunately, there's a lot of ways that you can fall on your face too. Okay, and the idea is to try to find that even keel with your program, so you don't tip over one way or the other. All right, you're not going to win all the time. Okay, I've got GW Life TV in the group, says buying Bristol Myers. I think that's a smart move. BMY ticker symbol. I really did look hard at it. I almost pulled the trigger, honestly. I probably need to add one or two more of the some picks to the healthcare sector. And I think Bristol Myers would fit the bill. There's a couple other, there's one biotech that I'm looking at right now as well. and I believe just forgetting the ticker symbol. It's not Regeneron. I forgot it. I typically don't forget those things, but that's all right. What's your view on bank stocks given the upcoming crash I keep seeing in the news? Well, you got to take the news with a grain of salt, certainly. Okay, if you try to write your investing career based on your news feeds, you're going to be sorely mistaken. But upcoming crash, I don't know if I would jump on that grenade. But I will tell you, just since you asked, the financial exposure, I did add Prudential this week. Small position anyway, at the 30 share position, something like that. I loved the valuation, 8.8 forward earnings on the PE with Prudential, with a little over 5% dividend clip. And I love the insurance business. There's a couple other insurances that I really liked. I did buy and sell BlackRock. That's the next financial company. BB&T, quite frankly, is probably the best value as far as financials go. And then you guys know I own the big five: Wells Fargo, Bank of America, Citigroup, JP Morgan Chase, and I do own a handful of regionals as well. Huntington Bank shares, Key Bank, SunTrust Financial, and there's a couple others as well. I'd have to log in to get you those regionals, but all holdings of mine. I think undervalued right now. I really wouldn't not buy the financials for fear of a looming recession. I really wouldn't. I'm actually in the camp that I don't think we're going into a recession. I don't think we're going into a recession. I think we're going to continue to be a little bit choppy. Time will tell if I'm wrong or right. I'll be prepared either way. It doesn't really matter to me. I'll still sleep easy at night. But it does not preclude me from owning financials in my portfolio. I think it's one of the most important sectors to have some exposure to. And I walk the walk and I talk the talk as well. Those are real holdings that I have in the financial sector. Again, check out BB&T, and then BlackRock. I did take just a trading position this week. It was a big position. It was eight shares when I already own a lot of financials. It ran up a little bit. I took a little profit. I was good with it. But $6 trillion assets under management with BlackRock. I sold out of my position in Blackstone Group. I really enjoyed them as an alternative asset manager. I liked it, ticker symbol BX. But great question, certainly. If that gives you any indication of my feeling toward the financial sector, Bank of America, I think I have Wells Fargo, Citigroup, JP Morgan, and I think that's it for the major banks there. Okay, all right, and Prudential. All right, good stuff. I like SBSI Regional Bank, one everyone should check out if you haven't before. So Jason's offering another pick there. Again, I think BB&T is probably my best pick right there, to help you guys kind of get into it and check it out. If I had money, I would look at Manual Life Financial. That's another one I own. So great. I own a couple more. TD, I own a couple, and I know Noella will appreciate this. I own Toronto Dominion, and there's another regional, the ticker symbol's RY. That's funny, I remember that, and I don't remember the name of the damn bank. But both Canadian banks, two of the biggest banks they have. Toronto Dominion is TD. We're all aware of that. And then RY is the other one. So please, if somebody knows it, you guys can help me out, throw me a lifeline. That's funny, I remember the ticker symbol and not the name of the freaking bank. Royal Bank of Canada. Thank you. Bob saw me drowning. He decided to throw me a PFD. I love it. Thank you, my good friend Bob. It's not one to sit by and let a guy drown. That's awesome. Thank you. Anyone who's interested in recession technically from Dave Ramsey, I heard this morning is 2 quarters of a contracting GDP, correct? Yep. We very well could be. It's just scuttlebutt and discussion at this point, honestly. We're 12 years into a bull market. I just don't buy into the whole we need to go into a recession because we need to go into a recession bit. I still think the economy is actually very, very strong. I just think the global economy is actually very, very weak. And if we think that the U.S. economy is going to continue to hold up around the world with the strengthening of the dollar and a continued trade war going on with China, and I don't think China is as scared of the U.S. as we make out. I don't. I think they can take a hell of a lot more abuse and are willing to do so. I don't think they can take it. I think it's their willingness to take it. And I don't think our willingness, because our stock market it can be like a child. It gets cranky and it can go down fast with the slightest headline risk. All right. And I think the Chinese know that. And I think we're on borrowed time with our current administration as well. And I think if they felt like all they needed to do is just wait it out, we run the risk of doing just that, right, wrong, or indifferent. You can agree with me. If you don't, that's fine too. But I think they're a little tougher than what we give them credit for. All right. China, ironically enough, cares about China. They don't care about the U.S. Sorry. Here's a little reality check for you. We will not know we are in a recession until we are in it. And that's a great point. I'm seeing some things right now that would lead me to believe that we are more on a downtrending market than we are on an uptrending market all day. I think that's a very smart comment, and certainly stuff that you want to keep in mind when you're observing the stock market. I don't think you ever want to put it out of your mind that a potential for a downturn or a jock in the stock market, a jockey to the downside, because it's usually a pretty trigger a capitulation sell-off, maybe that can throw it into somewhat of a tailspin, especially now with algorithmic and quant trading, where certain technicals are hit and broke through. I think that can really exacerbate some of the selling that goes on in the market nowadays. So it's a really smart comment. I like it. As part of the financials of my Roth, I also have some foreign banks as well. Yeah, those just the two Canadians banks that I have. I don't have any foreign exposure outside of Canada and US. And that really is a testament to how much value I put in the regulatory oversight of each of those countries. Okay. All right. Good stuff. Stephen T, do you think Costco is still a buy at 303? I do. It really is amazing that Costco can thrive in a market so dominated by Amazon and Walmart, and yet there's still Target doing exceedingly well. Target really surprised me. No kidding. But yeah, I think Costco is, I doubled up on my position. I talked about that last week. I think I've got 10 shares now of Costco. Yeah, 10 shares of Costco. And that'll be one of those cornerstones in the portfolio. It's just a company and a business that I want to be associated with. It's a business that I understand. It's very simple. It's a concept that I really, really like. And it's one that I'm proud to be an investor in. Again, remember, guys, investing is a luxury. Okay. Choose your luxuries wisely. Okay. Don't be frivolous. Investing in Costco is easy. It's not that hard. It's not. Okay. Yeah, I think Costco's good right here. I've owned it now for a while, so I'm up pretty nicely in Costco, but I think you're okay. It's a good one, depending on how it fits into the portfolio, etc. Okay. Had somebody talking about Roseburg on here. I can't believe somebody was talking about their parents are in Roseburg or something. That's kind of interesting. Stephen T says, took a new position in SPHQ. That's the quality from Invesco. That's a good fund. 98 individual stock holdings, Visa, Costco. Yeah, so it's more of a quality weighted rather than a dividend weighted. It's a good one. It's a really good fund. Like to know what the expense is in there. So that was me. My parents are in Roseburg, Jeff. Awesome. You have to You have to introduce them to my mom and dad, man. They've been there the whole life. So I don't know if there's any other Chartiers there in Roseburg. We're the ones. So my brother's there too. He's an electrician. So yeah, 0.60. That's a little spendy. I think SPHD is about half of that at 30 basis points. You know, I think you could probably gain some exposure to those in a little cheaper manner. But hey, that's an easy way to grab a hold of those 98 stocks in a little package with the bow on top and pay the expense in it. It's fairly expensive for a passive type of situation. It's not managed at all. So you're starting to kind of get into that range where it may not be so worthwhile. But it's a good fund. It's a good product. You can win with it long term. Certainly can win with almost any product, crappy or good, over the long term, just depending on how long you want to hold the fund for. All right. Definitely looking to get my cash to 33. In that way, I don't mind a drop. I'm certainly a lot further north than 33%. Definitely, my cash pillar is definitely right there. And then with some of the cash in the account as well, definitely pushes that percentage up. And got about 8.5% right now fixed equities. So reintroduce some of that $2,000 profit back into some fixed equity. So playing with some house money there, right? Looking to generate some long-term wealth in the fixed equity section of the portfolio. What's your view on John Deere? Love it. One of my favorite freaking companies. It's just unfortunate that I had to parlay one of my other defensive companies because I'm so happy to with the performance of Lockheed Martin and Raytheon, which I own fairly large positions in either one of those two as well. Northrop Grumman, I love the company. It's awesome, but I wanted to parlay some of my exposure. Industrials is one of my favorite sectors. Okay. Industrials is like the opposite of how I feel about investing in like, what's another sector? I like energy, but man alive, is it humbling. God dang. I've got some holdings in some deep water, man. I tell you what, Marathon Petroleum is one of them I just had absolutely licked. But right now at 9 times forward earnings on that stock, wow. I just can't believe it. It's come back a little bit, but John Deere's phenomenal. Absolutely love the company. You got to hold it long term. Worst mistake I ever made. I had it as a cornerstone in my portfolio about 2 or 3 years ago, and it ran up and I took profit, and it was the worst thing I ever did. And it was great profit, 20%, whatever, 25%. I should have just kept it. I would have had a doubler right now. I would have been up over 100% in John Deere. I think it's that good of a company, very well ran. Caterpillar, I feel the same way. I do own Caterpillar now. 15 shares of Caterpillar right now is what we've got. But again, my exposure to the industrial sector, my largest holding is UTX, and then all my defensive positions kind of pushes my exposure limit up. I mean, you guys are naming some, even Honeywell, that's the other one that I would own along with United Technologies. Honeywell, I actually like better, to be honest with you. I just don't own it. You can't own everything, but a lot of good options with industrials right now. As a sector, it really doesn't look very good right now. With everything looming, global slowdown, etc. There's a lot of headwinds with industrials, but if you want to be a contrarian, you want to introduce a little bit of exposure, now's the time to do it when nobody's talking about doing it. All right. That's just how you got to think about investing. Caterpillar is the same company now than it was 5 years ago. Okay. Same company. All right. Good stuff. We cruise up here and see if I can't cherry pick some of these other questions here. All right. Lines JL Colin would like to see you in a total stock market ETF. Like VTI, which may be a small percentage of bond exposure. Yeah, I really like that lesson. JL Collins does a 55-minute YouTube video. I think it's one of the best investing videos you can watch. You can watch that if you're not into reading investing books, which you can kind of get lost on. I highly recommend watching that message. It's legit. Like, the dude breaks it down. You think I break down stuff? He breaks it down in such a simple term. You're just like, wow. I wish I would have got that earlier on in life. That's what I kept thinking. And it was 55 minutes of an interview. And I was like glued to the interview. I watched it 55 minutes straight through. Boom, I was into it. But that's a must watch for anybody that's interested in hearing a good perspective about passive investing, ETF investing, why it is you're always kind of getting exposure to the cream of the crop in either the S&P 500 or the total market index. That is his favorite. It's not the VTI, it's the equivalent index fund that he mentions. VFIAX, I believe. I believe that's the ticker symbol that he talks about. It's the same fund. One's an ETF and one is an index fund. But it's a really, really good watch. Good stuff. So, Dan, thank you for that. I appreciate it. I'm probably going to go for another 10 minutes, guys. We'll aim for an hour and a half tonight on this live stream. It's been a lot of fun tonight. I really want to make sure that I've addressed all these questions. I'm going to the East Coast this month and never been. Awesome. I'd like to know where you're going. I was in the Capitol building last week. That was a lot of fun. Washington, D.C. is really a cool place. Really cool. I was surprised. But New York City's worth checking out. So happy trails to you for sure. Just make sure there's no hurricanes coming. Good grief. This is ridiculous. The Elite Taylor. Hey, Ryan, I'm 30. I've been watching for a while, especially the replays. Don't make the lives a lot. That's okay. I don't hold a grudge. But happy birthday. Glad you're sharing it with us. That's dedication. No problem. I'm glad to do it. I typically try to be as aggressive as I can about opening up this opportunity. I know that I'm ignoring a whole section of YouTube right now. I'm kind of selfishly doing that for a reason right now because I need the time, and I'm not going to press. Okay, I'm not going to press if I don't think that there's a lot of stuff I want to talk about. But to be able to press like that with a full-time job on YouTube, you guys need to understand something. I think it would be sometimes kind of cool to just come on and be part of the community and let me do all the hard work. I feel like you guys kind of carry some of that work for me, but putting daily uploads on YouTube is a lot of work. It's a lot. And it's something that I don't have the time for now. I think probably I would be a little bit more motivated. It's somewhat disheartening if you look at it from my perspective to be doing this as long as I have and to have such a genuine message like I think that I do. I think that I do. I have that turned back to me sometimes by some of the viewers who appreciate the message. But it's sometimes a little disheartening to see some of the other channels grow as quickly as they can. And then, we're kind of slowly just chugging along, and I'm prepared for that. But I'm also prepared to make a couple fundamental changes on the channel as well, to where hopefully we use kind of a double-edged approach to where we continue to do the live stream for the folks that come on and just want to kind of have a dialogue with a channel creator and investor along the investing genre topic. But also to appeal to some of the masses who may get turned on by a 5 to 10 minute video that I can put on with regard to a very specific topic that I'm going to talk about in the investing world. And I can do those quick as well. But just need to make a few upgrades to the channel as far as our efficiencies, improving some of the sound quality, some of the lighting quality as well in some of the videos. Those things are in the works as we speak. So stay tuned to those. All I ask for is your continued support to the channel. You're all part of something special. I truly do believe that. I really, really do. And when we start to get into specifics about what Christopher Blaine offered tonight, I think that's cool stuff, man. I think when we can come on and throw some real stock picks into the group here and just kind of talk about some of the companies out there, I do say a lot that there's no portfolio the same. However, the flip side of that is that there can be a lot of commonalities in approaching the stock market in a lot of different disciplined manners that have a lot of similarities. Okay, so the idea here is to pick out those things, a contribution amount, for example, or if you enter your investing dollars into the VOO and you do so with that reduced expense. Those are some of the commonalities that we can point out in the group, that we can all kind of revolve around and enjoy, because that is a common theme in my group. I don't want people to come on and miss the message of understanding that our goal is to drive down expense as close to zero as we possibly can. The effects are undeniable. Okay, it was a $30,000 response back to Christopher Blaine if he decides to stay the course in his current program or decides to lower the expense to either something a little bit more manageable or goes completely to a dividend portfolio, which will eliminate the expense altogether in a self-directed account. Okay, so those are some of those things that we want to continue to talk about. All right, thank you for coming on. I appreciate your time. Really good stuff. All right. Cruise on down here to the bottom. Make sure I've been using USAA mainly, then SoFi, Wealthfront for saving. Good stuff. Financial investors offering some options there on the saving side of it. What about IVZ? Almost 8% yield. I've kind of learned my lesson in trying to go for those higher than average yielders. I think the one now that makes me the most nervous is the one that's outperformed in my portfolio, and that is AT&T right now. I would be kind of careful going after that higher than average yield. Here's the thing. The risk that you have to take on to realize that higher than average yield may not be worth it. Instead of just entering into a company like a Prudential that I offered tonight, that I personally invested in for the two sheer reasons of valuation, and I'm getting a 5% dividend in that company as well. Very wide moat, established companies, been around for multiple decades, and I just think that may be a better way to go if that's what you're looking to do, is seek that higher than average dividend. I would also say that looking at an ETF that yields a 3 or 4% dividend, like the SPHD, for example, that we've offered in the group here, that's 50 stocks. That's 50 dividend payers out of the S&P 500. That'll render you 4%. So some good stuff there. Good ideas. Just got to be careful, man, because if you're going after that higher than average dividend and you take a haircut of 20%, that 8% dividend really isn't going to look so attractive. Okay. All right. I'm going to cruise up here one last time through the community tab. If you're in the group, I think most of you guys have hit the thumbs up to help support the message and let Google know that we're here, and not hiding under a rock. That's all right, though. We're doing what we can do. One of my foreign banks is SMFG. I'll have to look into that. MetLife was the other undervalued insurer that I was actually thinking of. MetLife, AIG, and Prudential are the three. MetLife is undervalued right now. GW got that one hit right on you read my mind. So very good stuff. All right. I think I've got through all the questions tonight, guys. Again, I'm going to kind of throw in the towel. I was able to thread the needle tonight. I hope you all appreciate that. I've been very busy with, obviously, the storm. Hearts go out, obviously, to the folks that were impacted. We will survive, certainly. But I do plan on making it real again next week, Friday, 9 o'clock Eastern time. If you have anybody who can come on and benefit from the message, certainly share it, invite them in to the message. I don't send invites out to people, so I do rely on word of mouth. The folks that are maybe interested in the message, share it with them. Let them know some of the basic terminology, some of the common themes, some of the questions that try to strike up you asking some questions about yourself, because I can kind of only show you how I make sense of investing, but we're not really realizing the true benefit of leveraging the YouTube opportunity if we're not getting you guys to answer those questions for yourself as to why you do it, and what your numbers are. And hopefully through tonight's lessons, I've kind of motivated you to enter into that comparing investment fees calculator within the Trading Academy. Very, very eye-opening exercise. And I hope you guys find the same amount of value that I did some many, many moons ago when I've walked through this exercise, and I've walked through it hundreds of times since then. It just keeps me that much more on track, and it keeps me more and more focused on my goals as we inevitably age with time. All right, guys. So thank you so much for making your way onto the live stream. Have a great, great weekend, and we will catch you next week. Thanks again so much for tuning in to the live stream. I'll catch you guys later.